what I did was I took up Dollar General, right? Basically a discount retailer. Yeah. So first of all, the growth and efficiency check, right? Recent earnings are good, but if you look at the last 5 years, not that great. 5-year free cash flow, highly volatile, right? Return on invested capital, yeah, it's basically, it's kind of gone from 14.2% 3 years ago to about 5.52%. So clearly says there's no real moat over here, right? Valuation 12.46 price to free cash flow, but I would say it's cheap because there isn't a lot of value in it, right? Now the big kicker over here is 213% debt to equity ratio.
That is very high,
Very, very high.
That is
Very
very
sky high. So they are expanding rapidly. They're putting in more money into new stores and all that, but that is coming from debt. That is not coming from free cash flow.
free cash flow. Yeah.
Right. Then looking at the KPIs, company is quite, I would say, managed in a sort of lean manner, but they are under financial pressure. Right. Now, if I look at their sort of beta is basically a measure of volatility in the market, right? Now they're 0.27, they're between 0.27 and 0.39. So the S&P 500 is like 1, right? So the overall market is 1. So we tend to look at whether the stock is lower in volatility or higher in volatility. So this one is basically lower in volatility, right? So and then if you also look at the average volume of that stock, volume only spiked when there is a recent earnings beat. Now, if you look at a number of technical WhatsApp chats and whatever, they will tell you there is a 20% performance on this, and the stock is doing really well, fantastic. But that volume only came when there was a earnings increase just now, right? It's not something that you can invest for the long term, right? It's basically just a very brief momentum as such. Now, this is what I do with ESG, whether they are greenwashing, etc., right? So what they are doing really is, they are basically classified as a severe violator, as far as we are saying, classified as a severe violator. Their occupational safety record is very poor. They've sold a number of products, etc. That is fantastic, but they pretty much underpaid their workers, right?
Where do you get all this information? To get
it's on their website.
Oh, in their website.
Again,
okay.
On their website, right? So these companies provide what is called as an ESG report.
Okay.
Right.
Yeah.
So you can download that, and then a lot of times what happens is the ESG report contradicts to what they say in the annual report. Right. So that means they're trying to lie through their teeth. Right. And the reason for that is many of the funds would look at the ESG rating and they would only read the ESG report and they would invest on that basis. Right. So when you compare it with the annual report and the ESG report, basically it's very easy to call off the line. Right. So this stock has been priced anywhere between 5 to 7% higher because of their ESG report. But the ESG report is largely a lie. Right.